Good afternoon. My name is John Shirley. I'm the Vice President of the Lifestyles Vendor Program. What my team and I do is we bring vendors into the vendor program to help meet your real estate investment needs. Today we have a fantastic class lined up for you. It is, to give you a little bit of a heads up, this class is not meant to be political. It's simply a comparison regarding the current tax plan and what Joe Biden's proposed plan is. The Exchange Resource Group is a nationwide qualified intermediary for all types of 1031 exchanges. They've been actively helping out our members since about just early 2014. In that time, they've been awarded multiple vendor awards, including Vendor of the Year. Our presenters today are Lu Ann Blough, Ken Paulman, and Dan McCabe. You guys want to go ahead and get started, guys?
Okay, hi everybody, this is Lu Ann. I am your main contact point for Lifestyles for 1031 exchanges. We feel very strongly about communicating this information to you so that you can be educated to what Biden's proposed tax plan as it relates to real estate, how it would affect you. We'll go to the next slide, Ken. So our agenda for today, because we are a qualified intermediary for Section 1031 exchanges, and because there is a lot of possible change in the Biden agenda, we're going to do an overview of the Section 1031 like kind exchanges for you first. We're going to show you the benefits provided. What is it and how does it work? I know we have a lot of clients on here probably, but if the Biden plan were to go into effect, we're going to highlight what it would do to the 1031 exchange. We're going to compare and contrast how it would affect the current tax law. And most importantly, we're going to go over several talking points on the potential impact on the real estate industry. And then at the end, we have a call to action. We're going to have a template that I think will be provided as a handout so that you can be proactive now and contact your congresspersons. Okay, so we're going to give a quick overview of the Section 1031 exchange. So next year, the 1031 exchange will be celebrating its 100th anniversary. Originally started in 1921 and has evolved to a certain extent over the years. So you as an investor, when you sell a property, you have a taxable sale. When you do a 1031 exchange, it turns it into a non-taxable exchange. You can defer your tax liabilities completely and permanently. Since 1921, the 1031 exchange has encouraged real estate and economic activity. That's why it was originally set into place, and it has done great things for the real estate industry. It gives you more cash flow because you're taking that money that you would have paid to the government and you're investing it into new real estate. So it gives you greater wealth building velocity. That's a big word. So what is a 1031 exchange? So in the IRS code, an exchange in which, pursuant to an agreement, the taxpayer transfers property that's been held for productive use in trade or business or for investment, and subsequently receives property to be held either for productive use in trade or business or investment. It is real estate for real estate. It can be a single family to land. It can be multifamily to single family. And it's any state in the US and Guam and the US Virgin Islands. Okay. So how does it work? When you have a property that you're selling and you reinvest your net equity and all debt into like kind, but remember, we're talking anything defined as real estate in your state. When you sell that property and you buy a new property, the IRS states that you are allowed to defer all of the taxes that would be otherwise payable. It also allows you to defer depreciation recapture. I find a lot of people don't even realize that they have this potential liability with depreciation recapture. It's 25%. Capital gains federally is 15 or 20%, a few variables in there. And I'm in Texas, and we don't have a state income tax, but a lot of states do, and that can range anywhere from 0 up to 13%. So you add all that together, and you're talking a significant amount of money that would need to be paid to the government instead of reinvested into other real estate. Oh, so the 15 or 20% really means a Medicare potential surcharge of 3.8%, depending on your income level. So Pennsylvania is the only state that does not recognize Section 1031 only for state tax deferral purposes. Okay, Ken?
I think we're going over to Dan for this, but thank you. Dan, you there?
I'm here. I thought, okay, I'll take it. What we did was we attempted to take a typical residential property and kind of walk you through it so that you can see how it applies. So let's assume for the sake of this example that we purchased it 10 years ago for $270,000. That was the net purchase price. We currently have it under contract. The gross is $350,000. We're going to net $325,000 after the cost of sale out of that transaction. We've done about $20,000 worth of capital improvements over the period of time, the 10 years that we've owned it. So that's a factor to be taken into consideration. And then we've also taken depreciation. This IRS allows depreciation on residences at 27.5 years. And if you simply take straight line depreciation, as we've done in this example, and which the vast majority of people do, we're looking at $98,000 in depreciation that's been taken. So the basis in our property at this point in time as of the date of sale is 192, which is the purchase price plus the improvements minus the depreciation. Real quick and easy way to calculate that. The purchase price plus improvements minus depreciation. So if you do this math, our overall taxable gain will be $133,000. That's our net sale price minus the basis. That's our overall taxable gain. Now let's look and see how our taxes are going to be applied. If we don't do a 1031, if we simply put the money in the bank, we've got depreciation recapture. So we've got to take that 98,000 times 25%. So that's $24,500 of simply depreciation recapture. The government allowed us to take the depreciation. Now they want it back. But it's still a benefit. And then we have $35,000 of taxable gain, which is our taxable gain minus the depreciation recapture. So in this particular case, we'd be looking at capital gains tax, assuming we're in the minimum federal rate of 5.3%. So, excuse me, a 15%, I apologize. That gives us $530,000 that we would have in capital gains taxes. And then because for that year, the sale will probably boost us up into the higher tax ramification zone, we'll have the Medicare surcharge of 1.3K, which is just 38% of that 35%. So this is the total. Now, the other one that's not here that I want to point out is the state tax. Ken and I happen to both live in Colorado. Here we have a 4.63 max rate. If you live in California, you'll have a 13.3 max rate. If you're in New York, it's in excess of 11%. If you're in New Jersey, it's in excess of 11%. And so depending on what state the property is located in or what state you reside in, you may well come under an additional tax levied by the state you either file taxes in or the state where the property is located. So this is simply the federal picture we're giving you here, but you've also got a state issue. The major states that don't have taxes, state capital gains taxes, are Texas, Florida, Wyoming. Those are the biggies that everybody's aware of. Okay, so let's just walk through and see what happened if we took advantage of a 1031 versus simply paying the tax. Under the recapture, we'd be paying 24.5 versus 0. Under the cap gains, we'd be paying 500.
No, 5.3.
503,000 versus a 0. 1.3 versus 0. And then the state, again, in every state but Pennsylvania, 0 versus whatever the amount might be. And they generally range somewhere between 5 and 13%. So the reality is you're going to be paying $31,100 of your profit to the federal government versus paying 0 to the federal government, assuming that you do in fact successfully complete your 1031 tax deferred exchanges. And we see that happening, what, gang, 99.9% of the time, almost always. Right. People are successfully completing their exchanges and having a 0 tax bill.
Yep, very high percentage. And keep in mind that capital gains rate, it's not outlandish to see that go from the 15% up to the 20% with a sizable real estate sale. Without a 1031, you get above currently about $470,000 for a joint filer. Your capital gains rate just increased by another 5%. And you may be adding a state tax to boot, so that 31,000 could go to 35,000 or even in excess of that amount, and will remain at 0 with the 1031.
And a big point there that Ken made is that sale is more than likely going to boost you into the next tax bracket, and so you'll have to deal with those issues.
Right. Okay.
Okay, so we've gone back and attempted to find the most neutral analysis we could find, and quite frankly, we found that from the Tax Institute, which is something most of you don't recognize, but for we who are tax geeks, they are kind of the gold standard of tax assessment. And using their numbers, which you'll see throughout this, we've attempted to assess at least those published aspects of the Biden plan. Now, in order to, kind of eliminate potentially some discussion at the end, or pre-answer some questions, I guess. Obviously, the devil is always in the details, and this will have to go through Congress, have to go through the Senate, and I can tell you that those are, if they're both in the control of the same party that has the president, that's a pretty easy run. If they're not, it's a much more difficult run. Just so that you all understand, this is not our first rodeo with these issues. We've, as president of the Federation of Exchange Accommodators years ago, we went back to Washington, D.C., testified before Congress on these issues, and were successful in keeping 1031. The last go round, the industry was not successful in keeping all of 1031, and they lost, we lost the ability to do 1031s on personal property. We used to do aircraft, fishing boats, antique cars, fleets of trucks and cars. Those were big issues, as you can well imagine, and they took that away. So you can no longer do personal property. Now we are restricted purely to real estate, and this time around, there's an attack on the real estate. So we're just going to focus on that today. but I just simply wanted to let everybody know that this has been a situation that the industry has found itself in before. The real estate industry, we have some great friends in National Association of Realtors and other professional groups that step up and help a lot. Federation of Exchange Accommodators is a big mover in presenting facts and information to Congress on these particular issues. So let's talk about the Biden plan.
Yeah, and Dan, real quick, I would just mention for those who may not be aware of that association, the Federation of Exchange Accommodators is basically made up of the qualified intermediary firms and individuals from around the country. And they have a pretty sizable political action committee to try and defend the benefits and ability for taxpayers to use Section 1031. Thanks.
And if you've ever lobbied, you know that the basic ingredient in lobbying is folding green, cash. All right, at this point in time, but in the black will be the current federal rates. In the red will be the proposed tax rates. So at the current time, corporation is 21%. They're proposed to increase that to 28. Individuals max is 37%. They propose to increase that to 39.6%. So a large jump percentage-wise for corporations, a little bit smaller for individuals, except as we delve into the package a little bit deeper, I think you will see that they are now going to put a lot more into the what's called adjusted gross income, AGI, which is what you're basically taxed on for individuals. So while that increase doesn't seem like it's a big percentage, what you have to realize is the pot that they're going to tax at that increased percentage, they expect to grow exponentially. And with any of these plans, I hate to use this terminology, but the reality is the devil is in the detail, and there will be some unintended consequences here. So we're going to talk about those as we go through, or what we anticipate the unintended consequences to be. And then also realize that you're probably going to get hit from the states because they're hurting every bit as badly as the federal government is. And we just got some updated information this morning, literally from the Congressional Budget Office, that shows the budget has just in August hit $3 trillion. Revenues are up 1%, spending is up 46%, and they anticipate and they're projecting that by next year the debt will exceed 100% of the annual GDP, and that's the first time that's happened since World War II. And then we're going to talk a little bit later about the effect on mortgages. All right, so the Biden plan basically eliminates or restricts 1031 exchanges. And basically what they're doing is they want to eliminate Section 1031 so that you can no longer defer tax liabilities through 1031. And instead, they're going to dissipate, do away with the capital gains tax and put everything in the ordinary income tax bracket. So if you're a top tier taxpayer, rather than even making the decision to pay a capital gains tax, which currently would be a 20% hit, you'll be faced with a 39% hit. In addition to that, the state income taxes will also be imposed, and you will no longer be able to avoid those or defer those. The 25% depreciation recapture will be gone, and all of that, rather than depreciation recapture, all of that gain will swing into your adjusted gross income and be taxed at that 25 or 39% rate, whatever it might be. And of course, the 3.8 Medicare surcharge, you'll be hit with that because of your income tax. So it appears the plan is to make that AGI grow as much as possible and then increase the rates on the AGI.
Right, and I would like to add that some sources are citing the Biden camp as proposing to eliminate 1031 altogether. Other sources are citing the camp as proposing to put a cap of 400,000 of adjusted gross income on Section 1031. And again, as we touched on a few minutes ago, you can probably envision with your own investments or others that you've considered that if it's a sizable investment, that sale plus other income you may have or you and a spouse may have from jobs, et cetera, can easily push you into a 400,000 adjusted gross income ceiling, and therefore that proposal would effectively eliminate it in the majority of exchange scenarios. So whether it's calling for elimination or a $400,000 cap, it is a big hit.
And just to point out that the written plan calls for elimination. I think, Ken, correct me if I mistake this, but we found two sources that have indicated maybe a $400,000 cap, but all the other sources have indicated elimination.
Right.
So,
right. Just want to be aware if someone were to say to you, oh no, he's not eliminating it, he's just reducing, you know, those that can use it. Well, know that if that's true from what some sources are citing, it's a very major restriction. It's not very forgiving. Okay.
And don't forget that when you're calculating that 400,000, the proceeds of your sale will be included in that, including any debt relief you might receive. So that's a big factor. I'm sorry, right ahead. So it eliminates capital gains treatment. And so all realized incomes become taxable at the ordinary income rates. And just to clear up one thing, you need to understand that when you walk into the closing, you may owe Wells Fargo or Chase or somebody $150,000 on that rental house. But when that is paid off at closing, the IRS considers that to be income to you. It's called phantom income. And it's income which you don't have cash, but it's a liability that's been relieved. So that's a factor also. Again, it increases the top rate to 39.6 from the current 20, which is a biggie. Almost doubles the rate, as you can see. And then we took a tax rates for middle earners, and we just used that term, and that was people who produce between 800,000 and 469,000 as joint filers, and it increases that from 24% if you took your cash today to a 35%. And under the existing law, your tax bite would have been 15%. That would have been the capital gains tax, but this is what it does. And of course, if you have $469,000 in a penny, it shoots you into that 39.6% bracket. So all of these are big factors to be taken into consideration. Now, another very important thing that we want to point out that really doesn't have a lot to do with 1031s, but does have to do with the real estate market, is what's commonly known as the step up in basis. And let me explain that to those of you who are not familiar with it. Under the current law, if you inherit a piece of real estate from your mother, from your father, from whatever, you get what is called a step up in basis. So let's assume for the sake of argument that your parents paid $15,000 for this house back in 1955, and you inherited it last month, and its current market value was $249,000. Your new basis is $249,000. So if you sell it 2 years from now for $270,000, you just have to deal with the difference between the $249,000 and the $270,000. Their proposal is to eliminate that step up in basis. So you have to go clear back to the original basis at which your parents purchased the property. And one of the unintended consequences is, how do you determine that? Can you find it? Did your folks keep good enough records, or did grandpa keep good enough records? And so your tax will then be on that original $15,000 that your parents paid in 1950 for the property and what you're selling it for today. So it really is a huge factor in estate planning. It's a huge factor in the transfer of wealth from one generation to another. It's a real game changer, because this has been, I've been practicing law since '73, and as long as I've ever known, this has been the rule. And so they're really making a major change
Dan, can I say something here too? I've talked to a couple people about this, a couple of our clients who have spent pretty much their whole life buying and selling real estate in order to leave a legacy to their children. And now it would, if this got through and this happened, it would be robbery because everything that they have worked for to leave to their kids is now basically just getting a punch in the gut.
Absolutely, and all that, all that work, all that effort, and all that proper prior planning just went out the window.
Because it would affect current people now. It wouldn't just be the people that start under, like next year, started doing this. It would affect everybody that has real estate that is in the process of doing that. Correct?
Correct.
Okay.
Yeah. If you're hoping that your grandchildren benefit, the benefit is going to be substantially reduced. And it's going to potentially result in a dual tax liability. That's what was paid by your parents, and so it's going to increase the value of the estate, and you may well have income tax due upon the sale. Now, let me point out one other thing that Ken threw a line in here for. Some Democrats have proposed that we not do taxation of capital gains on the sale of an asset, but that we do the taxation of capital gains on an annual basis. The name you'll recognize is AOC has proposed this. So their plan, and they're strongly influencing Biden, obviously, is that each year you would have to value your property and then estimate the value of your property and then pay the capital gains in the year difference, rather than waiting until the time of sale. I just see that as an accountant's retirement dream, because the tax filings will just become even more onerous than they are now. I don't know, that's not in his written proposal, but that's been in something that they have talked about. Okay, why do you utilize a 1031 exchange? Basically, so that you can keep more money in your pocket and continue to play the real estate game. So we just ran some numbers here. Ken, quite frankly, put this together for us. And what we're simply trying to show you is the treatment of long-term investing over a period of time. So simply assuming that the current status exists with the 20% tax rate, you can see the taxes paid. If you use a 1031 exchange, it's zero. If you don't use one, it's $20,000. And under the Biden plan, it would be somewhere between $27,800 and $43,400. So somewhere between a third more and twice as much. The after-tax treatment is pretty significant because you can use that under a 1031. You can carry the entire $100,000 forward. You only have $80,000 under the current, and under the Biden plan, you'd have somewhere between $72,200 and $57,600. So your reinvestment opportunity is significantly reduced. And assuming let's run this out over a period of time and watch how it grows. So I won't run through the entire thing, but let's just hit the highlights. If you, under the current law, your new property, you've got almost $700,000 worth of purchasing power. If you don't use a 1031, you've still got $442,000.
Can I interject?
Sure.
We're assuming when we come up with those numbers that the value of the property that you own is going to increase 5% annually.
Right.
Correct.
And then that's what we put in the under property value. And then under the Biden plan, you're going to have $360,000 in available purchasing power. So if you simply run over to the far right side, you can see with no 1031 exchange under the existing law, you've spent $42,000 in taxes. Under the Biden plan, you'd be at $55,500 in taxes. And now remember, we're just talking about the federal tax because we're not taking into account any state taxes here. We're not taking into account any 3.8% net investment tax either.
Well, and sorry, Dan, actually the Biden plan numbers do include that 3.8 surcharge. So
Oh, do they? I apologize. Okay.
Worst case, a taxpayer under the Biden plan would be paying 39.6 income tax plus the 3.8 Medicare surcharge. So that asterisk or those asterisks along the bottom row are significant too, because we're saying, well, these numbers are based on the best case under the Biden proposal, meaning your blended rate is at 27.8. You could potentially see that go up another almost 16% in taxation, which of course is going to hit these other numbers with the asterisks hard and bring down, again, your options to reinvest and the amount of cash you have to take toward the next reinvestment. So we'll move ahead another 5 years, and Dan, let you run through the highlights on this slide.
Sure. Well, as you can see, the major thing that I want to point out is your after-tax investment numbers and your new property purchasing power. Those are the biggies. Obviously, taxes paid continue to grow also. But what it's really doing is limiting your ability. You can see after a period of 10 years, it's almost 2/3 less in the purchasing power. And obviously, if you're a real estate investor that's attempting to grow your portfolio, that's huge. I mean, that is the biggest determiner, the biggest limiter. Let me rephrase that. The biggest limiter is that ability to put your cash down and borrow on a new property. Okay, Ken. And then here's the 20-year, the long-term plan. And again, you know, what I want to point out is your purchasing power is now, under the Biden plan, is now 1/10 of what it is under the existing plan. And just what effect will that have across the industry in terms of value of properties, in terms of deals done, and in terms of your ability to grow your own investment?
Right, pretty striking numbers there. And
go ahead, Ken.
I was just going to say, prior to the Biden plan proposal, this graphic was still very powerful. Just looking at the first 2 rows of data, you can see that utilizing 1031 exchange over a couple decades under our model of 5% growth and reinvestments with 1031, you end up with roughly 4.5 times the purchasing power that you would have without 1031. So we're, you know, of course, stressing the fact that there are some strong reasons to perhaps let the Biden camp know, whether you're a supporter or not, that you may not be in favor of some of these tax proposals because of what they may do not only to your portfolio, but also to the economy at large. And we'll talk about some of those possible consequences here in the remaining slides.
Right. We have some projections from the Tax Institute that we'll walk you through. Okay. These are the numbers from the Tax Institute. They've gone back and done an exhaustive study, that's what they do, of the proposals. And let me point out again, the Tax Institute is, I guess if it's anything, it's probably libertarian, or Tax Foundation, I apologize. And you can pull them up and read a number of articles that they have written. So we try to condense some of this down. They estimate that if this tax plan passes, it will reduce gross domestic product by approximately 1.5%. It will reduce capital across the U.S. Approximately 2.23%. They anticipate. I apologize.
3.23.
3.23%
Yeah, okay.
of the capital currently available will be reduced. They anticipate that it will cause a wage rate reduction of 0.98%. And this is a 10-year proposal, as you can see, 21 to 30, or a 9-year proposal, actually. And they anticipate that it will cost approximately 585,000 jobs across the United States. The tax foundation is generally pretty conservative in their estimations, not conservative in their political stance, but not known to be out on a limb on their estimations. So I'd say these numbers are very optimistic. I would suspect they may well be higher, because if you simply look at where the jobs have grown here in the last several years, the construction industry, particularly home construction and building construction, have been very strong economic drivers, and a significant number of job losses will occur in that industry as well as the real estate industry. We believe that without Section 1031, real estate transactions will be delayed or abandoned. We'll tell you why. We think that it's very highly possible that real estate values will erode. Anytime you limit the movement of a product, it tends to negatively affect the price generally. The national economy will constrict by 13 billion annually. The estimates we've seen have run from 13 billion, we use the least number, to 18 billion. And those come from National Association of Realtors, et cetera, et cetera. Several years ago, the FEA did some very extensive polling, and we're continuing to do that to make presentations to Congress. And at that point in time, 40% of the realtors stated that without Section 1031 exchanges, the transactions that ended up being 1031 exchanges would not have occurred. So you're looking at a big slice of the potential deals. People say, well, you're going to avoid taxes entirely. No, because the research reveals that 88% of the properties that are acquired in an exchange are ultimately disposed of in a taxable sale. So at some point in time, 88% of the taxes that are due, and it's probably higher than that because you have to figure that the property value has increased, but 88% of the properties acquired are ultimately disposed of through a taxable sale. So ultimately the taxes get paid, they just don't get paid today.
You want to talk about the mortgage now, Dan?
This might be a good place to talk about it. We talked about some information we just received this morning from the Congressional Budget Office. Bloomberg Financial also came out with some very interesting numbers this morning. Not in time that we could put it in here, but I think it's pretty important to talk about it. According to Bloomberg, the federal government now owns 30% of the mortgages in the United States. And prior to March, when COVID hit, that was only 21%. So they've jumped 9% of the mortgages just in this last relatively short COVID period. And at the current pace at which they're buying them, they will have, by the end of the year, they'll have 34% of the mortgages in the United States will be funded by the federal government. Now, what's interesting, at least from my point of view, to look at this is that a number of those obviously are single-family residences that may or may not be primary residences, but that we're faced with a double whammy here, in that if we lose 1031 and the number of transactions go down and values go down, the federal government, who's attempting to gain from doing away with 1031, is going to have a significantly higher liability on the other side, because they'll now own 35% of the existing mortgages. So, we talk about unintended consequences. What we may be doing is trying to build up income on one side, when in actuality, we're substantially increasing liabilities on the other. Just an issue to watch for, an issue to be aware of, something that's on the horizon.
Yeah, and another way to I guess, view that is, you know, the Biden camp and other predecessors have thought, well, the Section 1031 is a loophole either for big companies or for the wealthy. We see that that's not the case. Many of our clients, probably the majority of our clients, have one or two rental properties. It's part of their, you know, wealth building and retirement strategy. Well, in taking 1031 away, yes, the idea is we want to generate additional tax revenue to help the country, but it appears through a lot of these statistics that the actual outcome will be the opposite, right? You're going to collect tax on a much smaller pool because of the damage done to real estate activity. You know, just as we're saying, if 40% of realtors were involved in transactions that would not otherwise occur, what does that do to tax collections? You know, it's receiving a tax that didn't exist, but on a much smaller pool of transactions.
Most of the people in lifestyles, it's the lifestyles model to build your portfolio. You get people, clients coming in, just learning, we walk through, and then they make a plan to grow their portfolio. So, yeah, this is important.
And I can tell you from having been there and testified, most of the Congress people have no concept at all of this type of activity because they're relying on the federal government to provide their retirement. They're relying on the federal government to provide their income, and they don't. They seem to have a hard time grasping that a number of people are in real estate in a small way that is a growth factor for them and a long-term investment goal for the small investor. They think everything is owned by huge corporations, and they just don't really have, I guess, a good feel on the ground. And just so you understand, yes, this is our business. This is what we do. I've been doing this exclusively for 25 years, and for most of that 25 years, we've been dealing with Congress about every time there's a major presidential change. But this is by far the most far-reaching and drastic one that I've seen in the number of years that I've been dealing with 1031 since '77. So that's the reason we're bringing to your attention. That's the reason we're going to give you this information on a call to action, because this is going to, it appears if this comes to pass, that it will have a definite effect on all of our lives in whatever capacity and to whatever degree we're involved in the real estate game. So we have, in conjunction with the Federation of Exchange Accommodators, we put together a letter, and if you simply go to the action link, you can see that, review it, feel free to change it. But I can tell you that somebody counts these letters that come in and go to Senator whoever or to Congressperson whoever and says, hey, this is the feedback we're getting. So yes, they'll ultimately end up in the circular file, but somebody pays attention to the ones that come in and lets powers that be know. So this is really the only way and the best way, unless you happen to have a personal friend who's a member of Congress, obviously. But this is by far the best way you can have input in this particular arena, is by.
And it can start
exactly
now because it's your senators and representatives that are up for re-election too. So I think there's a lot of focus on just the presidential part of this election, but the Congress and the Senate are going to be key. So your congressmen and your senators need to know what you think.
And I'd just like to point out, you can actually download the sample letter right now from the control panel. And by the end of the week, if you go click on the legislative action link, it will also be housed there as well. But you can get it immediately today by downloading it.
Awesome.
Great. Thanks, Claire.
We'll be more than glad to answer questions. If you have some, we'll do our best to give you what information we have. We don't intend to start a debate here, but we do intend to educate and inform if possible. So,
we do have a number of questions for you guys.
I bet
So
you
the
do.
first one, so the first one is, does the Biden plan eliminate 1031 for sale of a primary residence, or is it specific to income generating properties, rentals, flips, etc.?
yes, Section 1031 does not apply to a primary residence. That's Section 121. And Section 121 provides for a $500,000 for joint tax filer, $250,000 for a individual tax filer, capital gain release. So it's.
Have we seen anything? Have we seen anything about that?
I haven't seen anything on 121 yet, but I haven't dived into 121 either.
Well, and I would add that just by virtue of the Biden camp calling for the elimination of capital gain, that could very well mean that Section 121 capital gain forgiveness goes away as well, to be replaced with, hey, now if you sell your primary residence, not only do you not have a 121 gain allowance, that's gone, and now you need to pay a tax on your gain from your residence at normal income rates, which would likely be higher for most Americans.
Yeah,
So we're speculating on that.
That's a natural reaction.
Yeah. We haven't seen anything in writing in that, though.
Okay. The next question, it goes back to the beginning of the slides, is how are you accounting for the legal costs of doing the 1031 transaction in the calculation?
I'm sorry, say again, the legal costs?
Yes. What are the, I guess, how are you, go ahead.
Under normal circumstances, there are no additional legal costs because it's a 1031. The title companies handle it. I have seen a couple of title companies add a small fee for 1031s. They don't do anything more than they normally do. So the only legal fees for a 1031 is the fees that the 1031 exchange accommodator charges, and I don't anticipate those changing in any significant way.
Okay. So the next question is, does your purchase of a new property in a different state impact state taxes?
It only impacts the state taxes when you sell. And certain states, the states are, well, what I call the high tax states, the states that are basically bankrupt and grabbing every penny they can possibly get their hands on, are doing all types of things. So that if you sell in California, New York, and Oregon, I think are the only three right now that have what's called a clawback provision. And so theoretically, if you sell in California and don't have to pay that 13.3% state tax, then California wants you, let's assume you moved from California to Oregon and you sell your duplex in California. They want you to report to them every year that you still own the property you bought in Texas as replacement property for the duplex. And if and when you ever sell Texas and don't do another 1031, then California expects you to pay them that tax. So that's a factor that will obviously be gone, because then California will, at least I anticipate, California will say, since you didn't do a 1031, you owe that 13.3% today. And it wouldn't surprise me that states like New Jersey, Illinois, states that have severe financial issues will do similar types of things.
Can I add a couple quick?
Sure.
One would be that we have not seen the effectiveness of clawback to this point. So the mechanisms are in place, but California and the other states that have implemented it have yet to successfully go after a taxpayer and collect that deferred tax. But one of the fears is that if more states adopt clawback, they could also adopt reciprocity, to where maybe New York says to California, we'll help you if you help us. And then those provisions start to have teeth where they can really go after that deferred tax in the event of another sale. And then secondly, Dan, please add anything as needed. Some states also have transfer taxes, but by and large, those transfer taxes can also be avoided or deferred with a 1031 exchange, and typically an additional form that you or your CPA would file. Is that correct, Dan?
That's correct, and that's applied in a lot of states. What's interesting in California, at least so far, the program has cost the state of California more than they have collected, which is, I guess, all too typical.
Yeah, making the problem they're trying to cure worse.
Correct.
Yeah.
Correct.
Okay, I've got one for you. If you add this to more restrictive rental laws like long-term eviction restrictions, rent control, and skyrocketing property taxes, the result will be removal of large numbers of rental properties from the market. Owners will sell their own occupants, will sell to owner occupants, and building will slow, negatively affecting those in the workforce housing by reducing both supply and quality. That's, I think that was more of a statement than a question.
Well, as a practical matter, I absolutely agree with it, and I think we're going to see that. A word we often hear, and having sat for a number of years on a county planning commission, is affordable housing, and I think that will be, quite frankly, a thing of the past, because the vast majority of rentals, at least the figures I've read from the state I live in, Colorado, are owned by individuals, not by large organizations. And those individuals have to make much different decisions when the government steps in and limits their income, but doesn't limit their outflow. So I anticipate you're going to see, if this does in fact take place, you're going to see a real reduction in the amount of affordable housing available, unless it's a government-sponsored program of some nature, which again will cost more money.
I would add that we talked a little bit about studies conducted a few years ago ahead of the last election by the FEA, by NAR, in support of Section 1031. While that was also in response to a federal government study that came out and said Section 1031 is costing the U.S. economy something like $10 billion a year, billion with a B. And to which these counter studies said, well, okay, your numbers are based on a vacuum. So if you do nothing except tax all of the current real estate activity, yes, the government would collect additional revenue. But in the real world, where we're not in a vacuum and real estate activity, just as that last statement mentioned, is going to impact the number of transactions, the value of transactions, as we said in a slide, real estate values will likely erode. That's how the Lingen, Petrova, and Ernst & Young studies concluded, sorry, federal government, your study in the vacuum is not correct. The elimination of Section 1031 would actually be devastating to the economy, and there's that $13 to $18 billion figure per year that those studies show, in damage to the economy and therefore to tax revenues that the Biden camp's hoping to generate.
Okay, the next one is, if you inherit before this change, should it happen, does this still cause a taxable event due to tax due at death and tax due on sale?
It doesn't appear that it will be retroactive. Under normal circumstances, whenever the federal government passes a law, it becomes effective the day of passage or at some preset date that they set forth in the legislation. But I do want to just remind everyone of one little statement. I happen to have it on my notebook. My son gave me some years ago, which it says, quote, "No man's life, liberty, or property are safe while the legislature is in session." Mark Twain. And I don't anticipate that they would change it, but it is always possible. If you inherited it tomorrow, I anticipate you would get that step up in basis. I think trying to do that retroactively would be a nightmare from an accounting purpose and point of view.
If you look at the Tax Cut and Jobs Act, which was the Trump administration's tax reform that was enacted in late 2017 and took effect for the most part January 1, 2018, it allowed for the completion of 1031 exchanges of personal property into 2018 as long as they had begun prior to January 1, 2018. So I think, Dan, to your point, that tends to be the typical rollout of a new plan.
Yeah, that is fairly typical, and just if those of you who are not aware, prior to that date, the personal property was a big aspect of kin's functions, and that's obviously gone away completely, and so is now an exclusively a real estate play.
Yep.
Okay. Just one second. Actually, Lynn wants to hop on, so let me unmute her real quick, see if I can find her.
I did it, John.
Oh, did
Hey,
you?
Lynn.
Okay, thank you.
Hey, everybody. I wanted to thank you for doing this. This is really beneficial to all of us. There's a lot of chatter going on in social media right now of people who are watching and listening and sharing stories about how critical the 1031 exchange was for their success as real estate investors. The ability to leverage that, as you know, you see it every day. You see the transformation of families and their ability to create wealth through this. And, you know, I was just sitting here thinking, I was just getting ready to respond to the group that at some point we may have to become single issue voters. And I know you don't want to wade into politics, so that's why I'm here. What I would propose to you, right, is that neither of the major parties have produced a candidate that's going to lead us through all the way completely through to the change that's coming. However, who we choose could determine whether it's going to be the next 10 years or the next 50 years before we get through this next period of change. And as real estate investors, I hope that you all feel the good that you do in communities. It is absolutely amazing the wins we create. Just think back, some of you have been around a long time. Those of you that are relatively new, when we went through the downturn and real estate investors were picking up properties, we were picking up properties that were destined to sit possibly for 10 years, empty, blights on the neighborhood, attracting crime. And instead we pick them up, we restore them, we provided jobs in construction, in lending, you know, finance. Mortgage brokers were pretty much wiped out, if you guys recall, at the beginning of the last crash. And we kept a whole bunch of them alive. And there were so many people who were able to make it through. And then we look at our communities, look at areas of Dallas now, look at areas of Houston, Central Texas, Arizona, oh my gosh, Georgia. Look at those downtown areas that were completely restored during the 10 years following the crash. That's us and people like us. So I'm just encouraging you to think about some of these things and consider being a one issue voter on some of these, because I really do think that I'm the one who wrote the statement, right? I think that this will be a disaster for the very people that these legislators say they want to help. Because workforce housing will be destroyed, in my view, under the implementation of these ideas, and that hurts the people among us least able to recover. And so, in my view, if you really care about what happens to people at the lower socioeconomic scale, then you have to be very careful of the intended and unintended consequences of your vote. So that's my plea, I guess, is what that is, right?
All I can add is well said. Absolutely true and well said.
And but I thank you so much for coming and doing this, taking the time to analyze it in a very balanced way, and then to present it in a way that we could all easily understand. This was very beneficial to me, at least.
Let me just add, if you have any
We
questions,
obeyed orders, Lynn.
if you have any questions, there's our numbers. We'll do our best to answer it for you in an impartial and as complete a way as we possibly can.
Okay, and I have one other statement I'd like to add on to that. You know, it's important for the call to action to send your letters in and email and whatnot. But in agreeing with one of our folks here, is that it's 10 times more powerful to call the offices of your elected officials than it is to send a letter, because you're a serious voter at that point. You're not just a letter. So kind of adds value to it.
And Lifestyles is being kind enough. This will be on the portal, but we're also going to be able to share it with other real estate investor organizations, which I so appreciate, Lynn, that you're allowing us to do that, because this is not, it's not just a Lifestyles issue, it's every single real estate person issue. So when we get the recording, we'll probably be sending it out to our email list. I will be posting it on all the 200 real estate investor sites that I'm on Facebook.
Yeah, we're going to run a campaign with it too. So everybody on here, if you're on Facebook, please pick up that campaign and post it with your thoughts. Include your thoughts and include, if you choose, include the action you've taken and encourage others to take action. And this is a time where we need to reach out and help everyone understand and help everyone see who we are. If you're on Facebook, you've probably noticed that we're telling a lot of stories right now about what specifically our apartment community owners are doing. And the reason we're doing that is to help people see us as people and not as corporations, and to see the heart behind true owners in America. Landlord has a really bad reputation for the few bad apples among us, like any profession, right? I mean, boy, we've seen that with police officers, right? So there's a couple bad apples and boy, they get all the press and they just slop us all with the mud. And so we're working on that. As much as you can pick those up and share them, it isn't about helping Lifestyles sell more memberships. It is about informing people who owners really are in America. I truly believe that. And I think the more we can get that word out and help people see what we actually do, the better off we're going to be.
Are we going on Twitter and Instagram too, Lynn?
Yes.
Okay.
Yes. Parler, all the major social media platforms.
I can only deal with 3. The rest of them, it's too overwhelming.
Right. That's why we have a team.
Exactly. Well, that's all we have to say. Is that Ken or John? Are we done?
Have a great day, everyone.
That's it. If you have any additional questions, you've got the addresses there. You can also find them on the vendor website as well, and send them any additional questions we didn't get to cover. Thanks, guys.
Thank you, John.
Thank you.
Have a great day.
Thanks, everybody.
Everybody.
Bye.